Today, the BEC chairman called for a ban on copper exports as so many thieves are hitting businesses to steal this precious metal.
We know the benefits that come out of there, jobs for our youthful population, skilled, non-skilled, semi-skilled if you like. Number two, business opportunities for our partners, investors, but also for the domestic businesses. It's very important that if we are driving the growth agenda, that we take care of issues relating to creating opportunities for domestic businesses in the ecosystem of what the mines is able to bring. Essentially, that's why we call for this investment.
Zambia is the second largest producer of cobalt in Africa after the DRC, but it's actually quite rare to find such large-scale copper mine.
Discuss the discovery of a significant copper deposit in Zambia by an American startup, Cobalt.
Demand for copper is surging. The red metal, considered a barometer for economic health, is a vital component for the construction and defense industries, as well as a key ingredient in electric cars, wind turbines, and the power grid. Offshore wind, for example, requires about 3 times as much copper as does coal-fired power generation in terms of tons per gigawatt of capacity.
The outlook for copper is very positive. I've never been more enthusiastic about it.
Something unexpected just happened in the global copper market, and it is sending shockwaves through industries that depend on it. Zambia, one of the world's most critical copper suppliers, has made a move that caught US and European manufacturers off guard, not with threats, not with sanctions, but with policy, almost overnight. Supply chains started asking hard questions, tech firms, auto manufacturers, energy companies, because copper isn't just another commodity, it's the backbone of the modern economy. So why is Zambia suddenly shaking the copper market? What changed behind the scenes? And why are Western industries now scrambling to reassess their exposure? Stay with us, because this isn't just about copper. It's about who controls the resources that power the future. For decades, copper flowed out of Zambia with little global attention. Ships moved, contracts renewed, prices fluctuated, and the world largely assumed the supply would always be there. That assumption is now being questioned. Zambia sits at the heart of Africa's copper belt, one of the most mineral-rich regions on Earth. Alongside its neighbors, the country provides a significant share of the copper that powers global industries: electronics, renewable energy systems, electric vehicles, construction, and defense manufacturing. In other words, copper isn't optional, it's essential. Every smartphone, every data center, every power grid upgrade, they all depend on it. Yet for years, Zambia's role in this system was largely passive. Raw materials were extracted, exported, and processed elsewhere. Value was added outside the country. Profits followed global supply chains, not local development. That model is now under review. What triggered the shift wasn't a single event, but a convergence of pressures. First, global demand for copper has surged. The push toward electrification, green energy, and digital infrastructure has turned copper into one of the most strategically important materials of the decade. Forecasts consistently show demand outpacing new supply. Second, supply chains have become fragile. Disruptions, whether from geopolitical tensions, trade disputes, or logistical bottlenecks, have revealed how dependent major economies are on a small number of resource exporters. And third, producer countries are asking harder questions. Why export raw materials cheaply, only to import finished products at a premium? Why absorb environmental and social costs while others capture most of the value? And why leave strategic leverage unused? Zambia is not alone in asking these questions, but its position makes the answers matter. When Zambian authorities signaled tighter control over copper exports and a stronger focus on domestic processing and value addition, the message landed far beyond Africa, because even incremental changes in supply policy can ripple through global markets. Copper prices don't just respond to shortages, they respond to uncertainty, and uncertainty is exactly what Western industries are now facing. US and European manufacturers have built supply chains optimized for efficiency, not disruption. They assume access, they plan production cycles years in advance, and they rely on predictable flows of raw materials. When a major supplier begins reassessing terms even subtly, it forces a recalculation, not because exports stop, but because conditions change. Suddenly, companies must ask, will supply remain steady? Will costs rise? Will contracts be renegotiated? Will processing shift closer to the source? These questions don't stay in boardrooms, they reach markets, investors, policymakers. This is why Zambia's move is being described as a shock not because it's reckless, but because it's strategic. The country isn't rejecting global trade, it's redefining its role within it. Instead of being just a source of raw copper, Zambia is signaling interest in deeper participation, refining, processing, manufacturing inputs, and retaining more value domestically. That shift challenges long-standing assumptions. For Western industries, the concern isn't hostility, it's adjustment. New rules mean new costs, new partnerships, new dependencies, and in a world already dealing with inflation, energy transitions, and geopolitical fragmentation, even small disruptions feel amplified. But from Zambia's perspective, the calculus is different. Copper is finite. Demand is rising. Leverage exists. Using that leverage doesn't require confrontation. It requires timing. And the timing is now. As global competition for critical minerals intensifies, producer countries are realizing that waiting carries its own risks. The longer they delay restructuring their role, the harder it becomes to negotiate favorable terms later. Zambia's approach reflects this awareness. Rather than reacting to external pressure, it is acting preemptively, aligning resource policy with long-term national interests. This doesn't mean immediate fallout. Factories won't shut down tomorrow. Devices won't vanish from shelves. But it does mean the era of unquestioned access is fading. And that realization is what has put US and European industries on edge, because once a supplier demonstrates agency, others take note, and once markets realize a resource is politically as well as economically strategic, pricing, planning, and power dynamics all begin to shift. Zambia may not dominate headlines every day, but in the copper market, it doesn't have to, it just has to move. And it just did. Once Zambia's copper signals began rippling through global markets, the reaction followed a familiar pattern. First came quiet concern, then internal reviews, then a scramble to reassess exposure, because the issue wasn't just Zambia, it was precedent. In global supply chains, what matters most isn't a single decision, it's what that decision makes possible. When a key producer begins rethinking how its resources are exported, processed, or priced, others start wondering whether they should do the same, and copper sits at the center of that question. Unlike oil, copper has no easy substitute. You can't electrify cities, build renewable grids, or scale electric vehicles without it. Every clean energy roadmap assumes steady copper access. Every tech forecast depends on it. That reality gives producer nations something they haven't always exercised fully: leverage. For decades, leverage was concentrated elsewhere: financial centers, manufacturing hubs, consumer markets. Raw material suppliers were often treated as interchangeable, but the energy transition changed the math. Suddenly, long-term access matters more than short-term price, security of supply matters more than spot market efficiency, and relationships matter more than pure economics. Zambia's signal landed in this context. It didn't say we're cutting the world off, it said we're rethinking how this works, and that distinction is exactly what unsettled Western industries. Because it forces a shift from assumption to negotiation. Inside US and European boardrooms, the conversation changed tone. Procurement teams began stress testing scenarios. What if export conditions tighten? What if local processing requirements increase? These aren't hypotheticals anymore, they're strategic planning questions. And the answers aren't simple. Diversifying suppliers sounds logical until you realize that many copper-producing regions face similar pressures: environmental constraints, political shifts, infrastructure bottlenecks, social demands. You can't just swap one supplier for another overnight. This is why Zambia's move resonates far beyond its borders. It highlights a deeper truth. The global economy was built on the assumption that resources would always flow outward, cheaply and predictably. That assumption is now eroding, not collapsing but eroding. Producer countries are no longer content with being passive participants. They want more control over timelines, terms, and transformation. And copper is where that ambition meets necessity. For Zambia, the goal isn't disruption, it's positioning. By emphasizing value addition and domestic processing, the country aims to capture more benefit from its resources while reducing vulnerability to price swings and external shocks. This approach also aligns with global trends favoring localized, resilient supply chains. In other words, Zambia is speaking the same language the world is already using, just from a different position that creates an uncomfortable symmetry. Western governments encourage supply chain security. Zambia encourages resource sovereignty. Both are rational, both are defensive, and both collide at the same point. This collision doesn't produce immediate conflict, but it does reshape expectations. Markets begin to price in policy risk, not just geological risk. Long-term contracts factor in governance choices, investors reassess timelines, and that's where the alarm comes from, not panic, but recalibration. Because recalibration costs money, higher costs ripple outward, tech hardware becomes more expensive, infrastructure projects stretch budgets, energy transitions face new constraints. None of this is catastrophic, but none of it is trivial either. What's happening is a redistribution of influence, slow, incremental, but real. And Zambia isn't acting in isolation. Across the global south, resource-rich countries are watching closely. Some will move faster, others more cautiously, but the direction is shared: more control, more local benefit, more strategic thinking. This doesn't mean the end of global trade, it means a change in its terms. Trade becomes less extractive and more negotiated, less automatic and more conditional. That evolution challenges industries accustomed to frictionless access, but it also opens space for new partnerships, ones built on mutual investment rather than one-way flow. This is where the story gets more complex. Because leverage cuts both ways, Zambia must balance ambition with stability. Moving too fast risks discouraging investment, moving too slowly risks missing the moment. The challenge is sequencing, aligning policy changes with infrastructure readiness and institutional capacity. So far, the signals suggest caution rather than confrontation. Incremental steps, policy reviews, strategic messaging. Enough to be noticed but not enough to break the system, and that may be the most disruptive approach of all, because gradual change is harder to reverse than dramatic rupture. As global industries adjust, they'll look for engagement rather than exit, joint ventures, local processing investments, long-term agreements that align incentives. In that sense, Zambia's move isn't anti-market. It's market-aware. It recognizes that scarcity creates bargaining power and that the energy transition has made copper scarce in strategic terms. This is why global markets are paying attention, not because Zambia controls everything, but because it controls enough to influence conversations, enough to shape expectations, enough to remind the world that resources are not just commodities, they're choices. And once producer nations begin exercising those choices, the global economy has to adapt. That adaptation is underway now, quietly, unevenly, but unmistakably.